So we continue our series of Meet the Manager videos, and we're delighted to be joined by Marcus Morris Eyton from Allianz, and he's one of the co-portfolio managers on the Allianz Continental European Fund. And this is a fund that we recently initiated coverage on, adding it to our buy list last month. Marcus, thanks very much for coming in to join us. I wanted, just as a summary, just to kick off, if you just give us an idea of the investment objective of the fund and also how you define your investment universe.
Yeah, so the investment objective of the Allianz Continental European Fund is to outperform the market by 2 to 4% on a rolling basis over the course of a market cycle. We've been fortunate to outperform by considerably more than that over the last 7 years since we've been running the fund. And we're of course looking to maximise the returns we can generate for shareholders over that time frame. In terms of our investment universe, we can technically invest in any listed company in continental Europe, which leaves us with an investment universe of over 5,000 stocks. In practice, we're segmenting that into a much narrower subsegment of the market, which fits our unique quality growth biased investment process. So we're really looking at probably 200 to 300 listed continental European equities.
If we maybe delve a bit more into that investment process, what are the sort of differentiating features in the way that you guys run money?
Yeah, I think we manage money slightly differently to the way many other growth investors look at European equities. And the first differentiating feature is probably our time frame. We have a very low turnover, long-term investment approach. So we're typically holding companies for a minimum of 5 years. And that's reflected in our turnover statistics, which are generally about 20% per annum. The second point, I think, is really the resources we have available to us at Allianz Global Investors. As many of you may know, we have a team of 70 in-house dedicated research analysts who are focused on that particular sector throughout their whole career at Allianz Global Investors. In addition to that, we have a dedicated Europe Equity Growth portfolio management team who are focused purely on these portfolios, which is 6 of us. And then we have something called grassroots research, which is an investigative field research that really allows us to speak to the customers and suppliers of a particular business and hear firsthand their perception of an underlying business. And last but not least, we've recently taken on an ESG team who are helping us engage with company management teams and really ensure that the alignment of interests between ourselves, of shareholders, and management teams is as accurate as possible.
So given that investment process, what sort of portfolio does that turn out, and how does that differ?
I think that the balance we've been able to achieve in the portfolio has always been a key factor. Over the long term, we've been able to consistently outperform in both rising and in falling markets. And in the pan-European portfolio, which we've been managing for slightly longer, we've now outperformed in 13 of the past 15 years. So it's consistent outperformance potential in a range of different market environments. For us, the outperformance opportunity is always single stock selection. And that's where stock picking, but also the company access we get is incredibly important to us. And I think being based in Frankfurt, in the heart of Europe, probably gives us far greater company access than many other investors are able to find because of the strength of the Allianz brand name and the assets we run. So we typically meet roughly 1,000 companies per year in our portfolio management team.
So let's move on to that stock selection. What are the key characteristics that you're looking for in a potential constituent of the portfolio?
There are many different definitions of growth in the market. We're very much focused in the structural growth camp. So looking for companies that exhibit sustainable earnings growth through an entire market cycle. So in order to do that, companies need to have differentiated business models and sustainable competitive advantages. And of course, that can range massively from company to company and sector to sector, but typically involve things like a best-in-class brand, cost leadership, very strong business models, and also the management teams and culture within a firm as well. And then because of the investment time horizon we've got, we're looking for companies that have the reinvestment opportunities to be able to reinvest those high returns on invested capital back into the business to fuel a future economic profit. And that gives you that very attractive compounding effect over the long term.
So could you maybe give us an example of maybe a high conviction position in the portfolio and just how the investment case works out for that?
Yeah, our largest overweight position in the portfolio today is a company called Infineon, which is one of the world's leading semiconductor companies based in Germany. And there are 4 divisions of the business, but probably the most attractive is the automotive division, which is 42% of revenues. And here you're benefiting from very clear secular growth drivers. So the first is the growth of ADS, so automated driver assistance systems. And the second is the transition towards electric vehicles. And Infineon supply 8 of the top 10 leading electric vehicle models. And actually, as you move from a mild hybrid engine, 40-volt engine, towards a full electric vehicle, the semiconductor content per vehicle roughly doubles. So that's a huge secular growth opportunity for the likes of Infineon. They also have cost leadership. They're creating a new factory which will give them a 30% cost advantage versus their competition. And we have a very strong management team who we think highly of. So that's one of our key positions at the moment.
So clearly this is very much a fundamental bottom-up driven investment process. But you mentioned earlier the number of manager meetings that you're going through each year. I wonder if you can maybe just touch on, given that number of meetings, just your overall outlook for the region and returns moving forward.
Yeah, we're actually much more bullish on Europe than we've been for a number of years here. Europe has done relatively well since the crisis, but the majority of that performance has been driven by multiple expansion. What's encouraging now is you're really seeing the underlying earnings growth of the corporates come through. And actually a lot of people forget, this is the first year since 2011 we will see not only any earnings growth, but actually double-digit earnings growth. And encouragingly, you've seen this upgraded as the year has progressed, despite the strength of the euro. So the meetings we're having with management teams, the optimism from them is clearly far higher than it's been for a number of years. And we also have the added advantage that the political environment is clearly improving, and valuations in Europe, while not screamingly cheap, are considerably cheaper than those you find in other markets, like the US or Japan in particular.
Yeah, very interesting, Marcus. Thanks very much for coming in and speaking to us. And if you'd like any further information on the Allianz Continental European Fund, please speak to your investment manager for a copy of our recent research note. Thanks very much.